Well, governments spent up big at the start of the COVID-19 crisis, but now they seem to be holding back quite a bit, even though the crisis hasn't gone away. Instead, central banks are stepping in. But does a bank's monetary stimulus really do any good at a time like this? Or is the only way for governments to continue with fiscal stimulus measures? And we'll debunk the myth that central banks create money with quantitative easing. That's today on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Welcome along. So, Steve, there's two ways that governments and central banks have coped with this pandemic and ensured that their economies don't totally collapse. Well, not so far anyway, but, you know, the jury's still out as to how it's all going to finish. But one way is fiscal support from the government. In other words, overspending, in effect, their respective budgets. And the other one is monetary support, which means lowering interest rates, including negative interest rates, which I'd like to talk about today, and quantitative easing, basically buying huge chunks of that government debt. Now, government support obviously makes sense, provided it's spent correctly. And we do know there's limitations on that as well, because for every decision that's made by a government, there's unknown implications about how it might change behaviour. But what about monetary stimulus, the other side, the stuff that central banks are doing? Is there really such a thing as monetary stimulus, I guess is the question. Because let's look at the $3 trillion added to the Fed's balance sheet since April. That is mainly the Fed. This is mainly QE, the Fed buying government bonds that have been bought on the secondary market, mainly from the banks. What does that really achieve for an economy, in this case, you know, the US economy, at a time like this? Is it doing any good at all?
Well, let's take one step back to what monetary policy used to be, and that used to be just changing the interest rate. Now, they can't change it anymore unless, as you say, we're going to discuss going negative, because they've pushed the rate down to zero, and we've been pretty close to zero or at zero ever since the financial crisis back in 2007. So conventional monetary policy used to be that you vary the interest rate, roughly speaking, twice as fast as the rate of inflation. So if the rate of inflation hits 2%, you put the rate up to 4%. And that idea was that was supposed to push the inflation rate back down again and target a 2% rate of inflation, which they saw as their nirvana level. And this was all supposed to operate through its impact upon people's willingness to invest. So putting up the interest rate was supposed to mean that firms who, of course, could, like, you know, as neoclassical economists so realistically model, they could rationally anticipate their future earnings, in 30 years in the future. What's wrong with that? Nothing surprising is going to happen in 2020, they tell me. And with that known future income stream, the only way you change the amount you invest is by discounting your future more, and by putting up the interest rate, you're forced to discount it more. So this would reduce investment. By putting up rates reduces investment, slows the economy, and brings you back to equilibrium again, that wonderful state that we all know by our own experience that the economic system is always in. Okay.
Yeah.
So that's
except when it's not, which is why
if it was in equilibrium, we wouldn't need
we wouldn't need central banks to be tinkering with it if there was such a thing as equilibrium.
I know.
It is a serious argument, isn't it? But I mean, even if that was the case, even if, changing interest rates changed your, the appetite for investment, whether now or in the future. Let me ask that again, because that noise will have come up. So even if that was the case, that changing the interest rate changes the appetite for investment now or in the future, that doesn't apply right now, because there's no appetite for investment, because there's a pandemic on and everyone is scared of the future. So in a way, I mean, even if fiddling with the interest rate was to change that behavior, it's not going to change that behavior right now because of the circumstance we're in.
Yeah, well, we've got to the stage where they're down to zero, and of course they used to talk about what they call the zero lower bound, the ZLB, and the dangers of hitting the ZLB. Well, they've hit the ZLB and they've been stuck there for a decade. So when this crisis came along, just as unanticipated as the 2008, but rather more justifiably so, the only tool they had left was the one they adopted after 2008, which is quantitative easing. And with quantitative easing, when you read the original documents of the Federal Reserve Monetary Policy Board. I've forgotten the precise name of the board, but it's the decision making that has people like Ben Bernanke on it when he was chairman, and Powell on there now.
So the FOMC you're talking about?
FOMC, thank you very much.
Yeah.
The FOMC minutes said that they thought by quantitative easing would increase the amount of excess reserves that banks were carrying, because We'll talk about the technicalities, but they literally thought banks would lend out reserves. Now, that's been something that my approach to economics has known has been wrong for about 60 years. And as in 2014, the Bank of England joined in and said, yes, it's true, banks cannot and do not lend reserves. So that way one's out of the...
But they do it sort of indirectly, don't they? So if you've got excess reserves, because they have to hold a certain amount of reserves in the bank to related to how much they're lending out. If they've got more reserves, then in theory they'd be able to loan out more. I know they in effect are creating that money when they issue in a loan, but they've got to have a backup, haven't they? Because they've got to pay other banks, they've got to transfer money from their account to other accounts. So they've got to have reserves, and that obviously the size of the loans that they issue is going to be related to the reserves they have in the bank. So if they've got excess reserves, then in theory they could issue more loans, couldn't they?
Well, no, are they at a limit set by the reserves? Of course, let's just clarify one thing here. The Federal Reserve has joined about half of the OECD just recently in abolishing reserve requirements completely. So, first of all, there are no reserve requirements, which is a good start to...
So it's all excess reserves.
It's all excess reserves, okay? Secondly, when you look at the scale of excess reserves, they used to run at pretty much zero. In other words, the reserves earn no interest for the banks. So they're an asset, which is basically they're a dud asset. So you don't want to hold a dud. You'd prefer to have an asset which generates a yield, which is where loans are obviously the major asset. But so are things like government treasury bonds and things like that. But the causation runs in the reverse. There's a wonderful post by John Canny from some years back called "Loans Create a Lot More Than Reserves." I recommend it to anybody who's puzzling over this, because he pointed out that though reserves aren't needed to lend, if you've lent, you need the reserves to match that lending at a later point, given when there were requirements for reserve requirements. So loans create deposits, they create a need for the bank to have extra equity, and they create a need to have extra reserves at some future date. So you might think that if they had the excess reserves, they'd be more willing to lend, but there was no shortage of willing to lend in 2006. And at that stage, excess reserves are effectively zero.
And there's no appetite for borrowing right now. So I mean, so even if if the idea of QE, and I'm looking at, it's a similar statement from the Bank of England, from their monetary policy committee, saying we use this money, talking about QE, we use this money to buy new bonds from the private sector. Buying these bonds stimulates spending and investment, helping the UK economy. So I mean, obviously their argument is pretty much the same, isn't it? That we give the money back to the bank. The banks have got greater reserves. They believe that's going to create more spending or more loans, and therefore more investment.
Every time I hear something like that, I haven't actually seen the episode. It's something Matthias Griselli points out to me all the time. But it's an episode of South Park where the gnomes go around stealing underpants, and the logic, they have a flowchart showing what's going to happen, and they have steal underpants. The second stage is question mark. Third is profit. And this is another one of those.
Sell underpants would be
because how is it going to stimulate the economy? Now, when you look at what actually happens with QE, the basic story is that banks and the central bank are involved in what are called open market operations all the time, because the bank used to be using open market operations to try to make sure that the interest rate remained within the target band they'd set. And that got blown out of the water when massive levels of excess reserves were created. So there was no more buying and selling of reserves to actually manipulate the interest rate. But nonetheless, when they started QE, they said, we are going to be on the buy side of those open market operations to the tune of $80 billion per month, which is roughly $1 trillion per year. So the banks knew, and the central bank knew, and everybody involved in it knew that no matter what happened in terms of the argy-bargy of buying and selling bonds,
the central bank would always step in.
Over the year, they would buy $1 trillion worth of bonds, more than they sold back to the private banks. Well, for the private banks, what that means is one of the income-earning assets they have, which are treasury bonds, and also they bought all sorts of bonds, mortgage-backed securities, all sorts of stuff. They would go down and their reserves would go up. In effect, the banks would make a profit in the transaction, otherwise they wouldn't bother selling the bonds, so they make a capital gain. But At the same time, they knew they were going to end up with $1 trillion of dud no income earning assets in place of the $1 trillion of income earning assets they had beforehand.
And that is what quantitative easing achieves. And it's happening with trillions of dollars worth of asset purchases by central banks like the Fed in the United States. We'll explore more of the consequences of that and other aspects as well, including of central bank policy, including the idea of negative interest rates. Do they achieve anything? We'll look at all of that in the full version of this podcast. To hear that, you need to be a subscriber at debunkingeconomics.com or become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen and you get access to the full version of this podcast and all the other ones as well. We'll be back again later on in the week. I'm Phil Dobbie. He's Steve Keen. Thanks so much for listening. See you soon.